Welcome to the Neptune Global Great Reset Report. I'm Chris Blasi. Today we have a very special show to offer you. We are fortunate to have one of the most informed analysts and commentators regarding macroeconomics, Fed policy, central banking, and money in general. But first, let me introduce my co-host, John Byrne. John is a trader and bullion specialist here at Neptune Global. He came to us a little less than a year ago after a 20-plus year career as a bond trader. So right out of the gate, he's been a valuable asset to the firm and also a great resource for our clients. John, welcome.
Thanks for having me. I appreciate it.
Sure. So now our special guest today is no stranger to probably most of our viewers. He's known as a lawyer, an economist, a investment banker, a media spokesperson for what's telling us what's going on in the world. And of course, he's the author of numerous books, including Currency Wars, The Death of Money, The Road to Ruin, The New Case for Gold, just among a few of them. And several of these have actually been bestsellers. So recently, he launched or published a new book, and that is called The New Great Depression. And this gentleman, of course, is Jim Rickards. Jim, welcome to the show.
Thanks, Chris. It's great to be with you.
Sure. So today we're going to be talking about your book, and for anyone who isn't familiar with it, it's The New Great Depression. This follows a series of books by Jim, and I've followed Jim for many years. And the reason I see him as such a valuable asset for investors and people trying to navigate what's going on in the world is I've known Jim for over a decade. And the things that the roadmap he was laying out for the future has basically all been coming to pass. So I think he has a tremendous track record, a real visionary. And what we have now in his latest book is telling us what we're living through right now and what the aftermath is going to be. So now, with that said, Jim, before we get going, I think we need a level set because it's really important, the term depression. Now, I know you've helped articulate what the true meaning of that is and what constitutes a depression. I think there's a lot of misinformation. So to get that right level set, can you just share again with the audience what is a depression?
Sure. I talk about this in the book and take the view that we're in a new Great Depression. Obviously, that's a reference to the Great Depression, which lasted from 1929 to 1940. And you're right, Chris, there is a lot of confusion about it. And I contrast the word depression with the word recession. Now, recession, the R word, has a technical definition. It's 2 or more consecutive quarters of declining GDP. There are a few other bells and whistles around that having to do with unemployment, but that's pretty much that's a good rule of thumb: 2 or more consecutive quarters of declining GDP. There's actually a group up in Cambridge, the National Bureau of Economic Research. They're the umpires on this. They call the balls and strikes. They officially say, when does the recession begin? When does it end? The funny thing is, often the recession's over and a year goes by, and then they say, well, it was over a year ago, because they just want to see more data before making those calls. But in this case, they have announced that, and they did this last year, that this recession began in February 2020. I agree with that. I think that's the right call. They haven't said it's over, but the evidence is pretty good that it was over, probably by July 2020. Going back to 2020 on an annualized basis, round numbers, first quarter growth was down about 5%. Second quarter growth was down about 31%. But in the third quarter, it was up 33%. Again, these are all annualized figures, so that it didn't get us back to where we started. In fact, we're still not back to 2019 levels of output, but growth is growth off a low base at that point. But so it looks like the recession lasted 2 quarters and was over by the third quarter, and we're into an expansionary phase right now. So then people say, well, Jim, how can you be talking about a depression if a recession is 2 quarters of declining GDP, 2 or more, and depression sounds worse? Gee, that must be 10 quarters of declining GDP. We haven't had that. Well, that's not the definition of depression. You can actually have growth in a depression. You can have 1 or more technical recessions in the depression, but you can have growth along the way. But the point is, it's depressed growth, meaning it's growth below trend. So if the long-term trend is, a little over 3%, which it is in the United States, but actual growth is, around 2% or maybe 1.5%. It's still growth, but it's depressed growth. It's way below potential, way below trend. And by the way, this was John Maynard Keynes' definition, so I use it, but I can't claim to have invented it. I figure if it's good enough for Keynes, it's good enough for me. He defined a depression as a prolonged stage of below trend growth with neither a tendency to get back to trend nor to collapse entirely. So it doesn't have to be a calamity, but it's not a recovery, a full recovery either. It's something in between, and it persists, and that's what we're in right now. Now, economists don't like the D word. They've banished the word depression from economic discourse for two reasons. Number one, it's subjective. Obviously, based on the description I gave, what do you mean by depressed? What do you mean by prolonged? Et cetera. So there's some room for debate there. And because it's subjective and not quantitative, you can't stick it into an equation. As far as economists are concerned, if you don't have an equation, it doesn't exist. Well, they're wrong on both counts. I mean, just because there are lots of things that we talk about all the time that are subjective, mood and various things that can be measured. And so that doesn't stop me from analyzing it as a depression. And just because it doesn't fit easily into an equation doesn't mean it doesn't exist. It does. So we're in a depression, and that's important because it means that a lot of the policy remedies that people are counting on, monetary policy and fiscal policy, just won't work. That you can spend money and you can print money, but that doesn't mean it's stimulative, and it doesn't mean you get back to trend. So yeah, we're in a depression. The right analog for what we're going through is the Great Depression. So that's why I call the book The New Great Depression.
So this way, I guess a lot of statistics, because as you said, I think the common belief is it's just it's a more severe recession. There could be a lot of statistics that come out from the government talking about growth and people not really realizing how acute the problem is, right?
That's correct. And the best single example of that is the stock market. So in February, March 2020, during the height of the first wave of the pandemic, the stock market fell about 32%. Well, 32% in 1 month, which is what happened, is a severe drop. That's a crash. But it's back. It started to regain traction in late March, and it's back up to all-time highs. I guess the NASDAQ has backed off a little bit recently, but it got to new all-time highs before the current correction, and as did the S&P 500 and the Dow Jones. So people go, well, what's the problem? My 401k is back. I lost on a mark-to-market basis last spring, but now it's back to where it was. Stock market's at new all-time highs. Happy days are here again. What's the problem? And I point out that, and I'll use the S&P 500 for this. I know people come home at night, turn on the TV, they want to know about the Dow Jones, but professional investors and asset allocators use the S&P 500 as a benchmark. But the problem is the S&P 500 is a cap-weighted index. That means that as a single company, your impact on the index is a function of your market capitalization. Well, there are 7 companies, and we know who they are. It's Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla. Those 7 companies are about 40% of the market capitalization of the S&P 500. So you should really call it the S&P 7. As they go, so goes the whole index. And those companies were the least affected by the pandemic. Nobody shut down Amazon. Nobody shut down Apple. Nobody shut down Microsoft. They're all streaming or digital or online or technology or entertainment companies. In fact, they're booming. If you can't go to the movies, everyone stays home and watches Netflix. If you can't go to a store, everyone shops on Amazon. So the stock market has never been more detached from the real economy. So let's flip over to the economy for a second. Restaurants, bars, nail salons, dry cleaners, boutique shopping, etc. And people look down their nose at small and medium-sized businesses. They go, well, restaurants closed, 20 wait staff and bartenders are laid off. Who cares? Well, I care, and those people care because they just lost their jobs, and the owner cares. But what a lot of people say, well, just shut everything down, shut down the restaurants, the movie theaters and all that. We have to lock it down and quarantine, which just as an aside, lockdowns don't work, but we can come back to that. But those businesses, those small, medium-sized businesses, collectively are 50% of all jobs and 45% of GDP. When you lock down small business, you're locking, even if you do half capacity, 50% capacity, it's equivalent of locking down between a quarter and one half of your entire economy. There's no way you can do that without permanently affecting behavior and reducing growth and creating an enormous amount of lost wealth. So I know what the stock market's doing, fine, knock yourself out, but that's not a reflection of the real economy. The real economy is suffering. And just one last point, Chris, everyone focuses on GDP, and that's important. That's how we measure the economy, but that's goods and services. It doesn't capture lost wealth. And let me just give you a simple example. So let's say I own a restaurant and I've got a going concern value of $2 million. That's what somebody would pay me to buy my restaurant. Well, let's say my income is $200,000 a year off of this restaurant. So I get a 10% margin on a value of 2 million. Well, if you shut the restaurant, GDP goes down by $200,000. But if I close permanently, I can't recover because you got to pay the rent and everything. The lost wealth is $2 million. So, okay, GDP suffering and it's coming back slowly. That's true. We're not back to where we were, but we're making progress. But what those numbers ignore and what the talking heads on CNBC ignore is the enormous multi-trillion-dollar lost wealth that has happened. And that will be a permanent intergenerational drag on a full recovery.
In the book, you write that deflation is the immediate risk to the economy. Now, given the fear of rising rates, which we've seen kind of creep its way into the markets lately, do you still feel that deflation is the more immediate concern than inflation, especially with new money flooding in from the recent stimulus package?
Yeah, they call it a stimulus package, but it's not a stimulus. Again, it's spending money. So yes, but I think it's really important to focus on the intertemporal aspects of this, meaning you can't just put a stake on the ground, say inflation, deflation. In the short run, yes, deflation or strong disinflation is the bigger problem. And I will come back to the bond market in a second. Longer term, meaning now late 2022, 2023, inflation is coming. There's a 100% chance of higher inflation in a year or two, and then beyond that for a very long period of time. So the inflation case is alive and well. It's coming, but not yet. And that's important because you get into these binary modes. Well, we're going to have deflation, we're going to have inflation. I'm saying we're going to have both, but they're going to come sequentially. So short run, deflation, disinflation are a problem. Longer run, I absolutely agree that inflation is a problem. But just to kind of relate that to your specific point, so we have all the stimulus spending, and the government handed out $600 checks at the end of last year, and they're going to hand out $1,400 checks in a couple of weeks. And so everyone's going to say, we're giving all this money. It's going to lower income people. If you make more than a certain amount, you don't get one. And they have a high marginal propensity to consume, like they're going to run right out and spend all the money. That's not what's happened. That's not what the evidence shows. Spend some of it, yes. But people are mostly using it to save or to pay down debt. And economically, paying down debt is the same as savings. So what people are doing, they're saving and they're deleveraging. They're not spending it. A little bit, yeah, we saw retail sales go up in January because the checks, the bill passed in late December. People kind of got their checks in the mail in January, and they spent some of it, and retail sales got a pop. But the savings rates are sky high. I mean, last April, the savings rate was 33%. Even in May, it was about 20%. It came back down to 13%, but now it's popped up again to around 15%. Those are sky high levels. I mean, if you look at a 10-year chart, the savings rate bounces around between 5% and 8%. 8% is considered high. 5% is, a little more on the low end, but it kind of moves back and forth in a range between 5 and 8. All of a sudden, it's up here in the 20s and 30s, and even today, it's in the mid to high teens. So, and I'm not against savings. Savings make sense. If you got fired, you got laid off, you're not taking your friends out to dinner. You're going to put the money in the bank. Even people who have their jobs are not spending because they're like, well, maybe I'll get fired next week. Maybe my business will be shut down next month. It's what economists call precautionary savings. In plain English, you're kind of saving for a rainy day, except it looks like it's raining out. So, so savings rates are very high. That makes sense for the individual. I'm not saying it's a bad idea, but in the aggregate, it's awful for the economy. 70% of the U.S. economy is consumption. Well, every time you save a dollar, you're not spending it. So savings can be a good individual strategy, and it can be a good development long-term for the US economy. But in the short run, it kills consumption. So that's why these handouts and this deficit spending will not have the impact that people expect. And money printing by the Fed is even more of a waste of time. I look at the Fed, but kind of, not that intently, because I think they're impotent. I think it doesn't matter. They have taken M1. M1 money supply is skyrocketed. It's gone from around 4 trillion to about 18 trillion recently, and the Fed's balance sheet has gone, round numbers, at the pre-pandemic around January 1st, 2020, gone from 4 trillion to 7.5 trillion today. So they have printed $3.5 trillion of new money. That's true. But how do they do it? They do it by they buy bonds from the dealers, and then they credit the dealer's bank account with money that comes out of thin air. Then the dealers, which are the big banks, give it back to the Fed as excess reserves. So the money didn't go anywhere. It got created. It got passed to the banks. The banks gave it back to the Fed, and they've got, as I say, sky-high excess reserves. But the money's not in circulation. It's not being lent. It's not being spent. And velocity is dropping like a stone. You look at velocity has been dropping, again, pick your money supply, but M1 velocity has been dropping for over 10 years, about 12 years. But in 2020, it looks like, look at the chart, it's like an Acapulco cliff dive. I mean, it goes straight down. And, quantity theory of money, nominal GDP equals money supply times velocity. I mean, it's a definition, it's an identity. Well, I remind people that $7 trillion times zero is zero. Meaning if you don't have velocity, you don't have an economy. So print all the money you want, but if it's not being lent and spent, then it does nothing for the economy. And hand out as many checks as you want, but if people stick it in the bank, which they are, it does nothing for the economy. So there is money printing and there is deficit spending at an unprecedented level, but it's not stimulative because there's too much debt already, and a very high now propensity to save. And so it's not kind of getting to the real economy in ways that are going to generate growth.
Back to the one thing on the book, very specific to the book, all your books are very good at first laying out what the situation is at hand, but also the predictive element to it, right? Where it's taking us, which I think is one of the things that most readers really appreciate. They're always looking for someone to help forecast the future. Now, despite this book being published in January of this year, you actually completed writing back in October of 2020.
Right.
And there's been obviously some radical things that have changed and happened in that period of time between the conclusion of your writing and publication, probably most specifically the election of Joe Biden and the installment of his administration,
right,
with the COVID vaccine becoming available. Now, despite those two big change events, and I think there was a substantial amount of the country who did not believe Biden was going to win, so pretty shocking, I think, to a lot of folks. But despite that, do those two events, the manifestation of those two events, the vaccine and the Biden administration, does that change your views and your predictions for the future in any material way?